Imagine waking up tomorrow and discovering something shocking. Every dollar, euro, or rupee in circulation exists because someone, somewhere, is in debt. Not just people, not just businesses. Entire asterisk countries, asterisk. Governments borrow money. Banks create money. And societies spend money that technically, asterisk, began as a liability, asterisk. But here's the strange part. This system wasn't always like this. There was a moment in history when money quietly changed its nature. When what used to represent asterisk value, asterisk slowly transformed into asterisk debt, asterisk no global announcement, no emergency meeting broadcast to the public, just a series of decisions, crises, and financial inventions that rewired the global economy. The real question is not asterisk how money works today. It's asterisk the real mystery is asterisk. How did the entire world accept a system where money itself is born from debt? Asterisk. To understand that, we need to go back centuries. For most of human history, money was simple. Gold, silver. Physical objects with intrinsic value. If you had gold, you had wealth. No bank required. Ancient civilizations from Rome to China used precious metals because they were scarce, durable, and widely trusted. But gold had a problem. It was difficult to move, difficult to protect, and dangerous to transport. So people began depositing gold with goldsmiths and early banks for safekeeping. In return, they received asterisk paper receipts. These receipts represented the gold stored in vaults. Over time, something fascinating happened. People stopped redeeming the gold. Instead, they simply traded the paper receipts. Paper had become money. But the real transformation hadn't happened yet. That moment came when banks realized something powerful. Banks noticed a predictable pattern. Most people never withdrew all their gold at once. That meant the golden vaults often just sat there, unused. So bankers made a decision that would change financial history. They started issuing more paper receipts than the gold they actually had In other words, they created money from promises If the system worked, nobody would notice. And for a long time, nobody did. This practice became known as fractional reserve banking, a system where banks keep only a fraction of deposits in reserve and lend out the rest. At first, it seemed harmless. More lending meant more business. More business meant economic growth. But hidden beneath the prosperity was a dangerous shift. Money was no longer tied directly to real assets. It was tied to debt obligations. And the scale of this system was about to explode. By the 18th and 19th centuries, governments discovered the usefulness of banks. Wars were expensive. Infrastructure projects were massive. Tax revenue alone often wasn't enough. So governments began borrowing heavily. Banks issued government bonds. Central banks emerged to stabilize financial systems and coordinate monetary policy. Institutions like the Bank of England, founded in 1694, pioneered the model. Governments would borrow money to fund spending. Banks would create that money through credit, and taxpayers would eventually repay the debt through taxes. At first, this relationship seemed stable. Debt financed development. Railroads expanded, factories multiplied, cities grew. But the system had a hidden flaw. Every time money was created through loans, debt increased somewhere in the system, which meant the total debt in the economy began growing faster than the money supply needed to repay it. That imbalance set the stage for something inevitable. Throughout the 20th century, financial crises began appearing more frequently. The Great Depression of 1929, exposed how fragile credit-based economies could become. Banks collapsed, savings vanished, global trade crashed. Governments responded by strengthening central banks and financial regulations. But the most important shift happened decades later. In **1971***, the United States ended the convertibility of the dollar into gold. This event effectively ended the Bretton Woods system. For the first time in modern history, major currencies were no longer tied to physical commodities. Money became fully fiat. Its value came from government authority and economic confidence. Not gold, not silver, just belief. From that point onward, central banks could create money more freely through interest rates, lending facilities, and asset purchases. The world had quietly entered a new monetary era. Over the next 50 years, global debt exploded. Governments borrowed more, corporations borrowed more, consumers borrowed more, and financial markets built increasingly complex instruments on top of debt: mortgage securities, derivatives, credit swaps. By the early 2000s, global financial systems had become deeply interconnected. Then came **2008***, the global financial crisis. A collapse triggered largely by excessive credit expansion in housing markets. Banks had issued loans to borrowers who couldn't repay. Those loans had been bundled into securities and sold worldwide. When defaults began, the entire system trembled. Governments responded with emergency measures. Banks were rescued. Interest rates dropped near zero. Central banks began massive asset purchase programs known as quantitative easing. The goal was simple: inject liquidity and prevent total collapse. But these policies had consequences. Debt levels climbed even higher. Every major crisis since then has been met with the same response: more liquidity, lower interest rates, more borrowing. During the **2020 global pandemic central banks printed trillions of dollars to stabilize economies. Governments issued enormous stimulus packages funded by new debt. Financial markets recovered quickly, but global debt reached unprecedented levels. Today, total worldwide debt exceeds $300 trillion. That number includes government, corporate, and household borrowing. Yet the underlying structure of the system remains unchanged. Money still enters the economy primarily through lending, which means debt continues expanding. And the question that once seemed theoretical now feels urgent. What happens when debt grows faster than economic growth forever? History shows repeating patterns: credit expansion, asset bubbles, financial crisis, emergency intervention. Then expansion begins again. Each cycle tends to be larger than the last, because each rescue requires more liquidity than the previous one. Housing bubbles become bigger. Stock markets become more leveraged. Government deficits become larger. Central banks increasingly act as stabilizers of last resort. Yet the fundamental paradox remains: if money is created through debt, and debts require repayment with interest, then the system constantly requires new borrowing to sustain itself. That doesn't necessarily mean collapse is inevitable, but it does mean the system depends on continuous growth and confidence. If confidence disappears, the entire structure becomes fragile. **1. Modern money is largely created through credit. Most currency enters circulation when banks issue loans or governments borrow. Money creation and debt expansion are deeply linked. **2. Financial crises often emerge from excessive credit growth. History repeatedly shows that when borrowing accelerates faster than economic productivity, instability eventually appears. **3. The system survives through adaptation, not elimination of debt. Instead of removing debt, governments and central banks typically restructure, refinance, or inflate it away over time. The global financial system isn't necessarily a conspiracy, but is a complex machine built on incentives, policy decisions, and historical accidents. Most people interact with money every day without ever asking where it actually comes from. Yet understanding that origin changes how you see economies, governments, and financial power. Because once you realize money and debt are deeply intertwined, you start noticing patterns everywhere. And one uncomfortable question begins to surface. If the world runs on debt, who ultimately controls the creation of money? If you found this breakdown useful. Make sure to subscribe and explore more deep dives into the hidden history of money, global debt, and financial systems. Because the more you understand how money really works, the harder it becomes to ignore the forces shaping the modern economy.